Hello everyone, good morning and welcome to today's video where we're going to be basically talking about multiple subjects that I've been asked about through either Telegram, right? Public Telegram, and the private community. I'm going to be basically mixing them up today. And I'm going to be going through a couple of subjects. Still don't know if they are all, as I am still waiting for maybe some other couple of questions being asked through, as I could still receive some questions. So we'll begin with why the 5 steps and not why just 3, right? Because as you can see, my strategy goes with 5 steps. The way that I execute goes with 5 steps that I've developed from what I understood and what I learned with the ICT Mentorship 2022, right? So my 5 steps are basically that let's suppose we have a bearish trend, right? The market will move like this, and in some cases we'll have liquidity being taken, then a market shift. I'll actually make that better because I hate it. We have a run on liquidity, market shift in the 5 minute. That 5 minute generates a fair value gap, and this, according to many people, is already an opportunity to be taken, right? Because we could be selling from entering with basically the fair value gap and with our stop losses all the way up to this high. Now, I have 2 problems with executing like this. First of all is the stop loss. The stop loss, we are in a 5 minute chart, and fair value gap could even be all the way down here, right? Trading all the way down there, meaning that we might have 10, 12, 15 pips of stop loss, which is a okay amount, right? I'm not gonna lie, it's an okay amount, but I'm more used to trading in a more lower time frame, which tends to give us a much better, much more precise entry. So that's problem 1, and problem 2 is that this could still fail, right? It could just go completely against us, being that this was just a run on liquidity, right, to continue going higher. So the reason why I trade with 5 steps is because I like waiting for the lower time frame confirmation, which gives me a little bit of a more precise entry. Let's suppose this is lower time frame opportunity, right? Gives me a more precise entry with the stop loss of maybe this could be 2 pips, while this one was 5 or maybe even 4, which allows me to have a better risk to reward ratio, better risk to reward ratio, and yeah, better risk to reward ratio. That's pretty much it. As an example, by going just to this low, I might already be getting 3 or 4 R where I can begin taking some partials or entirely closing the trade. While if I was on this entry on the 5 minute, this will be barely a 1-to-1, right? Which makes me have to trust that the market will actually go more time in my direction to gain basically the exact amount of profits that I could make on the lower time frame trade, right? Now, as an example, there are troubles with it because, of course, the lower time frames are, between quotes, less trustable, right? The lower time frames tend to give much more opportunities because the lower time frame creates much more candles in the meantime, while the higher time frames basically create a fair value gap as an example. So what could happen with this entry? This entry, what it could do is take us out for a loss, right? Continue a bit higher. Let me actually try so it doesn't take the high. Takes this high, right? Not this one. This high has to be respected. Let's suppose that happens, so we take a loss, and then the market does this. We have the market shift, we have the fair value gap, and that could have ended the next execution, which again, this gives us maybe a 1-to-a-3, 1-to-a-4, 1-to-a-5, down to this low already. While this entry was still giving us a 1-to-1, but in this entry, we would have taken a -1 loss, but theoretically, we would have taken a +4 or 3 R on this second entry. So this is pretty much the only issue that I've encountered, and actually I will show an example now because I did a backtesting video on S&P 500 yesterday. Well, actually yesterday is Friday, for you it's Saturday, but well, it doesn't really matter. Thing is that that S&P 500 trade actually gave an entry like this, which failed, and then the second entry actually works out quite well and gives us a profit that would have allowed us to recover from the loss and basically finish on really good profits, right? So the reason why I use the 5 steps are 2: a better risk to reward ratio, and the fact that this could have just failed without giving us a lower time frame entry. Of course, as an example, there are times where we have the run on liquidity, the 5 minute market shift, price trace back into the fair value gap, we have basically all of the steps, and this still fails, right? I'm not saying that if the 5 steps are not there, it's going to fail 100%. And I'm not saying if they are there, it's going to work out 100%, right? I'm just saying that I do understand that by the market giving us even more confluences in the lower time frame, inside of already a trade that we could be taking advantage of, it makes a lot of sense it makes a little bit more sense for it to actually work out due to us having much more confluences, right? So if we have a bearish market, we have run on liquidity, 5-minute market shift, and a fair value gap, this is already an entry, so that's a really good confluence. But if we go to a lower time frames, and then the lower time frames actually give us even another entry, that's 2 times what we needed. So, but with what we needed between quotes, of course. And this could be a better risk-reward ratio trade, better probability trade, and basically all of that. I truly believe that this strategy, or the way of executing this trade, has a really good win ratio. But it's mostly what lowers that win ratio is human error, right? So that's why I use 5 steps, and I don't just take the 5-minute fair value gap per se, because there are multiple things that could happen and it could just go wrong, right? I wanted to show you the S&P 500 trade as mentioned a little bit earlier. What do we have? Step 1, run on liquidity. Step 2, market shift, fair value gap as well. So step 2, actually this is step 2. Already a low that we can use as a market shift. So step 1, step 2, the fair value gap and the market shift. Step 3 is price trading back into it. We go down to the 1 minute, and the 1 minute does this. This move lower creates a fair value gap there. It doesn't have a market shift, right? This move lower doesn't create a market shift, doesn't cause a fair value gap. It goes higher, higher high, so higher low. Breaks the low, lower low. Now, the only way that we could have actually avoided this loss specifically is by understanding that the impulse is not really that impulsive, right? It's not a displacement kind of move, as mentioned as an example in the teaching video, on the 3-hour video where I taught how I try to look at the market. This is not that impulsive, but still, overall, it is the 5 steps. So we could have basically taken this loss. So this is a trade that basically, as you can clearly see, is taken as liquidity to then the better entry with a clear displacement ends up taken as liquidity and give us a even better opportunity, which has a pretty clear market shift, a pretty clear run on liquidity, and a pretty clear fair value gap, right? With, again, displacement, which is obviously lovely to see. And if we wanted to add even more confluences, look at those couple of equal highs. I always say that when the market reaches a level and reacts aggressively, or just reacts to that level, it's going to use it as liquidity. It's just manipulating more liquidity into the market, right? It's not really a concept. I don't think of it as a concept. It's just simply understanding how liquidity is built and understanding that that's just pure manipulation, forcing more liquidity into the market. What we can aim for, a couple of equal lows down here, already gives us a 4.5R. I think in backtesting I aimed for 4R, basically leaving me in 3% profit, or all the way down to this. And the reason why I say that is because theoretically, if the trend is going to be respected, where we have lower low, lower high, lower low, lower high, theoretical lower high, the lower low should be a no-brainer, right? Doesn't need to get there, but if it did, it would definitely make sense, right? Now, an extra confluence for it is this. Trendline liquidity. Just first mitigation, second mitigation, people believing that the third is actually going to react. It's used as liquidity, so the low theoretically should be taken. That's actually 6R, and the market gets there soon enough, but it does. This is why I don't like taking long trades, because they can retrace like that, and my psychology is not for that. But what did it do? Liquidity. Even in the lower time frames, run on liquidity, market shift, fair value gap, potential entry. Okay. Lovely trade, right? So -1, is that trade worth it? Definitely, because we're taking this one. Is that loss worth it? My opinion, it is. We have everything that we look for, right? So if it fails, it fails. I don't care about taking a loss like that one, because I know that in a different scenario, we're going to get a better entry, or an entry that's just going to work out. Maybe not necessarily better, maybe just as equal as that, but basically as simple as this, right? So -1 plus 4, as I said, backtesting was +4. On this one, we could have gone for +6. So either a 3% profit or a 5% profit. That's why I use the 5 steps, right? They're going to give you losses, of course. Not necessarily going to be a 100% thing. I don't think there is a 100% thing. But most losses are actually There's another example in here if you wanted to check it out. I think that's it. Let's move on to the next one. Something I would like to mention about what we're about to discuss is that we will be going over it again with the reversal, retracements, and counter trend idea subject in this exact same video. So that is also very important to combine with this subject that we're just about going to talk. So just enjoy. Next subject is how to allow trades to profits to run longer, to run farther away than what we could aim for. And that's a complicated one that it could be simple, but still complicated. And as an example, I personally don't like doing that. I don't like long trades. If I was to basically take a trade that is 10R as an example, let's actually draw it. Let's suppose we had a stop loss like that and a trade like this. Lovely trade, right? We have a very nice, I don't know how much this is. Actually, we could do it with paper trading, right? Since we're on it. Not paper trading, trading view. I suppose we had a trade like this. Change the color. 6 pip stop loss and looking for 6 or something like that. I don't know if it's pips, points, whatever it is. 10-hour trade. If I have a trade like this, let's actually draw price action along it. The trade, so we have better understanding. So I suppose the market is coming like this, right? We have reasons to believe price is actually. This is what we're expecting. This is our entry. This is our stop loss, right? So theoretically, that's our trade. What do I see here? Let me continue to draw this a bit more. Suppose something. So what we're aiming at, and then it's retracement, blah, blah, blah. So this is the structure that we have. Why am I drawing so much? Let me actually think about it. Because of this. Cool. So we have a theoretical 10-hour trade, right? And we believe that the market from this point, based on the theoretical reversal that we have, or the fact that maybe we have a higher time frame belief that from this point there's a probability that the market can go higher, and we do get the 5 steps to believe that that is a little bit of an extra confidence, right? Let's suppose the daily trend is bullish with trading inside a daily fair value gap to continue to go bullish. We're taking liquidity. We see a clear theoretical, again, reversal in the market, right? So we can try to take advantage of it. Here's the thing. The trade has potential to go higher as much as this, or maybe even further than that. We could be getting 20, 15R, whatever it is, right? What's going to happen on this trade specifically? First of all, it's a pretty large trade. So what can we see in the market when being inside a long trade? The market is going to do something like this. Let's suppose the entry is actually going to work out, otherwise the example wouldn't make sense. So starts like this, right? Starts impulse in, and it takes this highest liquidity. Maybe it does something like this. Takes liquidity here, right? Maybe reaches our break even or our point of execution. Then it continues going higher. Takes this couple of equal highs, also this, right? So it retraces a bit more to then continue going higher. And then it maybe finally reaches the target, or let's actually do it a little bit more, a bit better, you know, something like that. Sure. I suppose that's our trade. What would I do with this? First of all, I'm really happy with a 1 to a 4 or a 1 to a 5. So as an example, already, let's actually say this is our target. So, that 10R, that's actually exactly 10R, okay. 10R, right? We have 10R as a target. I have multiple highs to the left that are going to be used as liquidity. That's reason for price to go higher, as it is also reason for price to take that and potentially turn against us. That's reason for price to take and maybe reverse a little bit to then just continue going higher. So me personally, as mentioned just a second ago, I am very happy with 5R. If I can take a 5R trade at the beginning of the week without taking any other loss that week, or before that basically win, I am done for the market. I'm literally done for the week, because a 5% a week is 20% a month, and I just aim for 10 to 15% a month. So 10% for me, it's a huge amount of money. So as an example, 5R are all the way down to this point. That's 5R. So for me to have to digest, let's say, price to potentially retrace here and then continue going higher, and maybe then retrace again and then continue higher, basically as I drew here, all the way up to this, my psychologist doesn't really allow me to do that. Could I become a little bit stronger by practice and by understanding that the market, if the analysis is correct, is going to go in my direction? Definitely. Do I really want to though? No. I don't intend to do that. I was, to those that are aware with not aware, but if that are aware of phantom trading, I traded with them for a good time. I was profitable with their strategy for a couple of months before I actually started trading with ICT. And those trades were horrible for me because you were taking 10, 15, 20. There were occasions that you had maybe a 40-hour trade in your hands. That could take hours, days, maybe even weeks, depending on if you actually want to hold the entire profit. And I just don't like it. I'm really happy with 5R. As an example, what do we have with this one? I'm saying that just so you know that I don't like this. I don't like going for long trades. So even if I have the opportunity to take a 10-hour, I'm likely closing at the very least 90% of my positions at 5R or maybe even 4R, depending on how much I actually trust the trade. If I actually want to allow trades to run all the way up to this, I'm going to close a lot of partials, me personally. But I'm going to answer the question on how to allow profits to run longer. So if your analysis is correct, you've backtested and you understand that the strategy works and can allow you to take this 10-hour trade, you have to trust your strategy. You have to leave the charts. You have to set up alerts so you know where the market is. Maybe you want to close partials at 5R, right? And you say, okay, so I received the alert, 5R. Let's close half of the positions or 30 of the positions, 30% of the positions, whatever it is that you want to close, and allow the rest to run. Or maybe on the next high, you use it as another area to take partials. Or maybe you just say, I'm going to allow the rest to run all the way up to take profit, right? So for me to allow trades to run longer, I need to understand that my strategy works, that my way of execution works and allows me to take this profit, that I'm aiming at something that makes sense. Because let's imagine the next. Let's actually go to this. Let's assume this is our daily chart, right? We have a pretty clear daily bullish trend, right? And we have something like this. So market shift, around liquidity, right? Continuation going higher. We have a fair value gap here that hasn't been mitigated. So what's this? This is liquidity, right? And the market traded back into this. Trend is quite bullish, right? Let's suppose it's literally the DXY, which has been bullish for, I think, 2 years or a couple or an entire year. I don't know. Thing is that it's really bullish, so we understand that that's very likely to continue. We have price in discount, very discount, because we're aiming from this low to that high. We're also going to talk about Fibonacci in this video. So this is equilibrium, so we're definitely on discount. We are inside a daily fair value gap that was never mitigated. We just took an important low, because keep in mind that this is the daily chart. We just took that liquidity and we are inside this daily chart. What is the expectancy that I would have from this trade? If we are correct, theoretically, the market will get all the way up to this. If we got this entry, this specific entry, right down on this bottom, we have 100 or 400 or 200R. Of course, I would never take this because I'm not first of all, I don't think I will be able to find the trade that is actually the bottom. I don't think I'm capable of that. And if I were to do that, I'm closing it at 5R, so I don't really care what happens afterwards. Would I love to see a 400R trade running on my account? Of course, but I'm just not going to take that. I'm not going to hold it for that long. So the expectancy is for price to get all the way up there. We believe that the market can definitely go higher from this point, not necessarily from our entry. Let's keep that clear. But from this point, we understand that price can get all the way up to this, or at the very least up to this. But the target that I'm showing here is just something like this. I suppose a bit of a high, low, and this is what I'm aiming for. That's already 10 hours. So you can imagine how much this is, and this, and that, blah, blah, blah. So we are at a pretty good area to try to buy. What else could we believe that the market is actually going to feel? A fair value gap going back into premium, right? So the 50% equilibrium, at least we want to see price trading back up to premium before theoretically maybe changing direction or just continue going lower, right? Those are targets that we can use to believe that the market can definitely go higher than that, than what we're choosing to aim at. So here's the thing. I think I'm rambling a little bit too much with things that are not that important. The thing is, if you want to keep a trade going longer, you need to have reasons to believe the market is likely to go in that direction. Whether it is liquidity, whether it is the favor of the trend in, as an example, something like daily chart, the 4-hour chart, the hour chart, depends, of course. And that the lower time frames, that the, as an example, with my the way that I trade with the 5 steps going all according to plan, those are reasons to believe the market will go in your direction, and the rest is psychology. Because you can have, as an example, let's suppose we actually had something like this, right? Let's suppose we actually have the opportunity to be buying down here, believing that we have a really high probability of getting all the way down up here. And we actually get the confluences, blah, blah, blah. We get the execution, and this is where we are. At that point, maybe we are at 5, 6, 7, maybe even 10R already. Right? Maybe we're even at 10R on this move, tiny bit of a move in the daily chart. We need this psychology to allow a 7R trade, which could be a 7% profit, to do something like this and return back to 2%, and then go up to 16%, to then retrace down to 10, to then go back up to 20%, then retrace, and maybe even range for a couple of days where it goes between 20% and, I don't know, 15%. So then a huge continuation that makes us 30%. Just retracement down to 20 again. Continuation finally taking that high for maybe a 40-50% profit. Of course, I'm saying percent because I'm not counting the partials that we're taking. If we have 7R here, I'm probably closing I don't know, 60% of my positions. Then on the break of this high, maybe I'm breaking even a little bit more. Not breaking, taking some partials as well. So all of these moves all of these highs are being taken, also highs that we have to the left, maybe even a fair value gap could have been a target there, are areas where I'm taking partials, but I need the psychology to hold this trade. I personally can't. I have had a strategy that allowed me to take a trade like this, right? Maybe just executing down in the bottom if I made the analysis correctly, if I was right about the direction and everything. And I could have held a $100 trade, a $200 trade, but me personally, I just can't. If I see 10% profit running in my account, I'm closing that. I'm not even allowing it to get to 10%. That might be bad psychology. That might be bad trading. I'm a short-term trader. Yeah, I want my trade to be closed in minutes if possible, or maximum a few hours. I want to be out of this position immediately, right? Not immediately, of course, in the day, basically. So you can have every single confluence you need to buy here, but to allow the market to do all of this bullshit that just goes against you each and every single time that the market retraces, maybe this could have gone even deeper back to something like this, taking liquidity and then moving higher. You have to be able to handle that. How are you able to handle that? How do you learn to handle that? By practice. By practice, by understanding again, your strategy, that you believe that the market is likely to go higher from this point, that it makes sense, right? From the higher time frame, whether it's the daily, the 1 hour, depending on what you're executing on, but also in the direction. And mostly psychology, because the analysis, in my opinion, tends to be somewhat easy. I don't want to say it's easy. It tends to be easy when we have so many things in confluence in our favor. Taking an entry like this shouldn't be that hard. I can't take this trade. Let's just say it like that. I cannot take this trade. I couldn't take this trade down in the bottom. Gonna say that so I don't get any commentaries. But if you manage to take the execution down here with the 5 steps as an example, whether it is on this tiny bit or just this entire structure, then you need the psychology to hold it all the way up there. You need to trust the strategy, trust the direction, and trust that your target is okay, right? And of course, partials. Partials allow you to be happy. Because when it moves up to this, maybe you have a 10%. If you're closing 20% of your positions, that's a 2% profit. And you allow 8% that is running currently to run the rest. Maybe here you have 15%. You close another 2% in profits. That's already 4% profit that you made on this trade. And maybe then this is your final partials, and then you allow the rest to run all the way up here. So maybe in this trade you took a 6%, or let's call it 7%. Well, when it gets all the way up to this, you get maybe another 5%. That's a 12% profit. right? But the partials that you take in the meantime allow you psychologically to say, okay, so this trade is making me money, I need to hold on to it. And if your analysis was correct, your target is correct, the direction is correct, the psychology is the only thing that is going to fuck you, right? Literally, it's the only thing that could say, I am happy with this, close the trade. Because again, I have had trades that I could have taken, or that I did take, that could have been closed at maybe 20R, right? 20R. There are days with news that maybe I took an execution down here, right? Trades up to 4%. Cool, let's close it. That's 4% for me. I'm down for the market, could be down for the week. And then you have a tiny bit of a retracement. Am I happy that I got out of the trade? And then news kick in and do this. That's a 20R. 20R trade that were in my hands. Could have passed challenges, could have made $4,000 with it, that I would have kept $3,000 at the end of the month after dividing profits with the prop firm. And I'm happy that I took that 4%. I don't care about this. Of course, before the news, I would have closed it, so I would have still missed out on the news, on that move. But anyways, rambling too much. Thing is that to hold trades longer, you need psychology. Because the analysis, technical analysis overall is 20% of trading, 80% of trading, or maybe even more percent of trading is psychology. Looking for the concepts to happen all together, waiting for the concepts to happen all together, and then the psychology, right? To hold it through those retracements, through those moments where the market could turn against you, right? Multiple times. Another interesting subject we're going to be talking about is reversals, counter trend ideas, retracements, and that's mostly using higher time frames to either trade against the trend, as an example, or to understand when we're on a retracement or when we could be on a reversal. And I actually did talk about this with the private community, reversals, where to find reversals, where to actually look for reversals. I don't remember what I called that video, but I'm pretty sure we talked about it. So here's the thing. Let's do an example on the daily chart. Daily chart. Or our chart. I could look into charts, but I'm not going to be looking for examples. You can do it yourselves, because this is pretty. It's just understanding. Just a little bit of common sense. Okay, let's call it that. So in the daily chart, maybe your trend is something like this. Let's suppose this is the daily chart, right? Have them move lower, retracement. Move lower, retracement. This could easily be the daily chart on euro dollar, right? This is what we have on the daily. Now let's look at a portion of that price action on the 4-hour chart. Let's suppose this is the price action that we want to see on the 4-hour chart. Well, the daily chart was clearly a retracement. We have a clear impulse. This is not even a change in direction. This is just the market going a bit higher, but just slowly. We can understand that this is a retracement because of the impulse that it creates, because of the fact that it doesn't break any important structure, and maybe because it's taking buys of liquidity, right, and going lower. Simple as that. I suppose we're looking into this price action in the 4-hour. The 4-hour was going lower, and out of nowhere, this happens. This is both run on liquidity, let me zoom in, run on liquidity, but a market shift as well, right? So it will always depend on the context. Yeah, I should have done, we'll change that structure later. So what's going to happen now? Now we have the opportunity to say prices may be going lower or maybe going higher. So ideally, due to this trend, mostly, we're going to be lower. We're going to believe that this is just a run on liquidity to now continue going lower. What could happen in this example? Which is what we're going to talk about. This could be in the 4-hour a reversal, while in the daily chart, it's just a retracement, a tiny bit of a move. So this move here turns out to be a retracement that mitigates a 4-hour fair value gap, takes sell side liquidity, market shift, lower time for market shift though, and then continuation higher, right? And then we see another move lower, and then another move higher, and then another move lower. And let's suppose that move lower is actually this, that actually continues with that major time frame trend. So what happened in here? If we were to use as our bias the 4-hour chart, we would have believed this entire time that this is a bullish trend, that the market is just going to continue higher. So instead of believing this could happen, we were most likely believing that it is very likely for the market to continue to go higher from, as an example, a fair value gap in here. Now, this is why multiple people say that multi-time frame analysis, top-down analysis is very important, because when we understand that this is just a retracement in the daily chart and the continuation lower will happen at some point, we can understand two important things. The fact that this move is limited. We can't expect for this daily high to be taken. So as an example, above this high, I'm closing trades. Above this high, I'm closing trades. If I was to take buys here, I would have targeted those highs. Or maybe in the daily chart, we had a fair value gap that market could be reaching into, or equal highs, right? Equal highs that the market was reaching into. And that's what we could have used as targets on the 4-hour chart. I hope I'm making myself clear here. So counter trend trading ideas depend on higher time frames, because if the daily chart has had a very aggressive impulse and then you see the 4-hour, or as an example the 1-hour changing directions, you could expect the market to maybe turn around for a bit, retrace, range, consolidate, to then continue going lower. So that will be a good idea at that moment to maybe look for a reversal. Is it a little bit suicidal or not suicidal to say it better? Is it like trying to catch a falling knife? Definitely, because we're trying to buy when we are down here, and it's not ideal, right? Ideally, at this point, of course, as an example, if I see this, I am expecting price to retrace 50% at the very least, or liquidity, and then continue going lower, just understanding how the market works. Simple as that. But if we see reversals, we can take advantage of them, because keep in mind that this could be an entire month of price action, right? So now let's look at that exact same thing, but on the 1-hour. Let's suppose that this is what we're looking into the 1-hour, right? So it's going higher, right? Clearly, we have run on liquidity. Well, it didn't actually run on liquidity, so let me just run it again. Run on liquidity, continuation higher, blah, 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 liquidity, continuation higher. And out of nowhere, we see this. Run on liquidity, yeah, but it actually turned bearish. Okay, so we're bearish now. Right, and we get multiple opportunities. As an example, this could have been around liquidity, this as well. This could have been the 5 steps in there. Maybe this is near kill zone, blah, 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 and so on and so forth. And then, as an example, it turns up again. It's bullish, right? So we're seeing this price action, this, and this price action, this. So what am I trying to illustrate here? Do you want to take counter trend idea? I love counter trend ideas. I love trying to take the bottom or the top. I don't do it anymore because it's, again, I'm trying to catch a falling knife, but this is the way to do it with whatever strategy. I'm not saying this is how I trade it or that I created this at all. This is something that I do believe is somewhat common sense if you understand how the market actually works, how the multiple time frames actually go together, because overall they are representing the exact same thing. They're representing the exact same thing. It's just different time frames, different perspectives, what we're seeing. So do you want to take a reversal? Understand that this is a impulse on the 4-hour. 4-hour is going higher, so it has been impulsing for a lot. And then the 1-hour, this tiny bit of a move here on the 1-hour is much bigger, and you can see that there's a market shift that then respects a fair value gap and gives us, as an example, the 5 steps on the 50-minute chart. Can you sell here? Definitely. You're trying to sell this retracement, and then maybe you try to buy this continuation of the trend. That's how you understand what's a reversal, what's a retracement, what's counter trend trading, and how to counter trend trade. That's exactly how you do it. Do I recommend doing something like this? No, but if you like those, because as an example, I was always forcing reversals all the time. With whatever strategy I was using, I was always trying to, if price was going higher, I was expecting for the market to do something like this, turn around, and then just drop. But all that it will do, liquidity, continuation higher. Basically, if you want to trade reversals, if you want to trade counter trend ideas, if you want to look for counter trend ideas, this is the way to look at them. To look for them by understanding that the daily charting here was retracing. So you're definitely going to see a continuation low. Not definitely, sorry. Let me actually rephrase that. You understand that it's likely for price to actually continue lower in the daily chart. So you understand that this is a retracement, but maybe you have targets in the daily chart that you can aim for in something like the 4-hour, the 1-hour, or whatever. Keep in mind that, again, this is maybe an entire month of price action, where if we just look into the 5 and 15-minute time frame, this is an entire week. A bearish week, a bullish week, a bearish week, a bullish week, and then continuation, bearish, and whatever. This is how you try to pick tops and bottoms. I don't recommend doing that. I don't recommend that at all. It's not really that profitable. It's ideal to just go for the continuations, honestly. They're the most simple ones, right? So if you want to trade a counter trend, this is the best way to do it. This is how I recommend you do it, right? Of course, everything in demo. Already we should all understand that. So I think that's it about reversals and retracements and counter trend trading. This is a retracement. This is a reversal when strong structure is just being broken, and then the market just starts respecting the exact opposite direction. For a reversal, you need liquidity being taken, being at a very discounted premium price, multiple factors, right? Or maybe above or in a higher time frame target, right? Multiple things, right? Multiple things. So I think that's it about that one. That's actually a really good video. Well, really good section of it. I really enjoyed that one. Pre-market analysis. How do we do a pre-market analysis? I'm actually not going to explain this one because I think it's simple and I've shown it multiple times. If you go back to my channel, of course, if you're in the private community, you have 12 videos of that already. If you are not in the private community, you have anyways videos on my channel. Let me actually go to my channel. Not sure what profile this is, but we won't check that out. Subscribe to Only Me and ICT. You're in my channel, right? This is my channel. You go to this little thing. Of course, it's in Spanish because, well, Chrome doesn't understand that I want in English, but, well, it is what it is. You put live, probably, well, yeah, live analysis and execution. I think down to this. This is spirit strategy. Yeah. So if you were to use this, right, from this, no, actually not from that, from this one all the way higher, these are all live sessions, which I do the pre-market analysis and show you how I do that pre-market analysis. And what is it that I look for in the pre-market analysis? Let's do that. On the pre-market analysis, when I jump onto a chart, as an example, let's do it with, although this is a bad example because it's fucking NFP Friday, but if I get up at around 7, but jump on the chart around 8:30. Actually, don't do that, but okay, let's just say it like that. This is what I'm looking at. If I when I get on the charts, and this is the exact price action that I see, I'm looking for highs and lows that have been taken. What's the overall direction? What liquidity has been taken with the overnight price action? What's going on, basically, right? Because there are multiple things that could have happened overnight that I need to understand, that you need to check out, just to know what could happen next. As an example, looking at this price action, what am I going to expect? Look at the market. Look at what we had. Price was going aggressively higher. Retracement, continuation higher, high, and look at what happened. That's run on liquidity, market shift, reversal, continuation. What we literally just discussed. Could we look into the daily, then the 4-hour, then the 1-hour? We could definitely do that. Am I going to do that here? No, because we just want to check out the pre-market analysis, right? So I do see this, quite an aggressive move. This is a range, this is a consolidation. What do I expect to happen based on how the market works? Impulse, correction, or retracement, right? Depends. Doesn't really matter. Thing is that impulse, correction, whether it's, again, retracement or consolidation, to then continue going lower. That's the first thing. Can the market go higher in this session? It definitely can. So we're going to analyze both ways. So what do we have? What do we have bearishly and what do we have bullishly? We understand that the market, using the daily bias per se, or what we had on this, again, this entire thing that happened, we understand that the market is likely going to go lower. Can it go higher? It definitely can. But let's look at the confluences. We have a range in this. Huge liquidity above this couple of highs, even a couple of mitigations back here. A lot of liquidity above this couple of highs, right? What happens here? Price takes that. What does it do immediately after taking those highs? Aggressive move lower, break of structure, market shift maybe. Although market shift would have been here, but let's call it this market shift. retracement, aggressive move lower, retracement, market shift, change in direction. So run on sell side liquidity, change in direction. Can we be looking for buys? Sure, look for buys. Run on liquidity, aggressive move lower. You cannot compare how the market moved going higher here to how it went lower here. How it went higher here to how it went lower here and lower here. Okay, just gonna say that. Just use your imaginations. So also another reason to believe price could have gone lower from this market shift is that this is respected. So if we're seeing this, am I going to trust this? Sorry, am I going to trust this change in direction and believe this is going to happen? No, for two reasons. What we had earlier, all of the buy side liquidity that was taken, and the fact that the market going lower actually created sell side. Does it take sell side liquidity? It definitely does. Does it create sell side liquidity? It also does too. We take buy side liquidity and it just continues going lower. So this is what I want to know before I jump into the market. I understand that the direction is likely bearish, again, due to what we had yesterday, basically. This enormous amount of liquidity being taken, the fact that the market took liquidity one more time, and now what do I expect, or what am I going to be looking for? The 5 steps. The 5 steps, that's exactly what I look for. I wait for the market to, as an example, at this point, we already have step 1, step 1. Step 2, we have a fair value gap in here, maybe something in the 15, we won't do that. Step 2, right? So step 3 will be this, lower time frame entry, step 4 and 5. That's what I'm looking for. Or as an example, a high to be created. Maybe we see something, maybe we see something like this. Liquidity, market shift, fair value gap, lower time frame entry. I'm just looking for the 5 steps because I understand it's very likely for price to go lower. If it goes higher, what do we do? As an example, I might completely avoid it, but as an example, price has taken equal highs, good market shift, fair value gap, and look for lower time frame entries in there. Could this be a true to swing, a run on liquidity to now continue going lower? Definitely. Am I going to be looking for the confluences to that as well? I'm definitely going to do that. Because as an example, I'm 100% convinced of taking sells. 60, maybe 70% convinced of looking for sells. So sells, buys. Right? So even if I have the 5 steps to buy, I'm going to be very careful with it. Might take half the risk and might completely avoid it. Right? So if sells show up, I'm 100% taking them, of course, again, as long as the 5 steps are there. And if I see the buys, I don't know if I'll take them. Right? Because my pre-market analysis tells me it's likely to go lower. Due to what? Liquidity, direction, and theoretically daily buys due to, again, the run liquidity and the immediate direction change. That's my pre-market analysis. That's how I like looking at the market before I actually jump onto them. Somewhat similar subject, which I won't really discuss too much, is daily bias. Yes or not? Do we need a daily bias? Is it useful to have a daily bias? Do I use a daily bias? And I was going to explain it on the charts. Not going to do that because I made a video recently. Well, actually last week I think it was, where I showed GBP dollar through London taking both buys and sells, getting out of the market with 12R. Probably even that, because even more, because I did say like it took more losses than I actually did. So 9R on GBP dollar just in London session. To be fair, New York session those couple of days did literally nothing, so not much for us to use. But 9R profits by taking the 5 steps in whatever direction they show up. It's something that I don't do because I don't like just trading because it shows up. I like trading because it shows up and it makes sense in the direction that it actually shows up. But that's 9R taking a GBP dollar with multiple losses and multiple wins. So do you need a daily bias? Not really. Is it convenient and useful to understand what the daily chart is likely to do? Of course it is. If you understand that the daily chart is going to go lower, then all that you're looking for is exactly this. Run and buy sell liquidity, and you're looking for sells after that. This is around in a lot of sell liquidity and market shift. Are you going to be looking for buys? Are you going to take the loss in here? Very likely not, if you understand that the daily chart is going to go lower. That's how you avoid losses. That's how you understand to not go against that trend. That's how you look for continuations and not reversals. Going back to the previous subject. So I'm just going to say that about daily bias or not. You don't, in my opinion, you don't need it. I use it, barely use it, right? Ideally, if I have a clean and obvious daily bias, I'm going to go in that direction. But if I don't have it, I don't really mind. I most of the times I just use what I have in front of me, what happened before the market, and yeah, basically what happened before the market. Last but not least, a question about Fibonacci, when and where to use it. And Fibonacci is like thinking about trend lines. If you've been in Forex for a long time, like I've been in Forex around 5 years, losing money most of those years, but in Forex for a couple of years, you probably use trend lines, and you might think, okay, so I'm looking for the third touch and a trend line to try to buy. You have touch 1, touch 2, touch 3 completely fails. Of course, it's a retail strategy. But what's the problem? We have first touch, second touch. Now we have first touch, second touch, potentially a third touch. First touch, second touch, potentially a third one. First one, second, potentially a third one. First one, second one, potentially a third one. And so on with the bearish one, of course. But in this case, we can't really do the bearish ones. Let's suppose on this one, first one, second one, theoretically the third one, reaching into that. So what am I trying to illustrate on this one? First of all, trend lines don't work. Second of all, is the Fibonacci is a little bit like that. It's of course useful, but it can be a little bit of a pain in the ass when we don't know where to place it. Because again, it's very, I'm trying to look for the English word, but I'm not going to find it. You can use it from here to here, from there to there, maybe even there, right? So you have multiple ways, and it depends a lot on how you decide to use it. As an example, what I do remember from ICT is that this impulse doesn't have the 50% mitigated. So you can move it to the next swing, which the 50% is a bit lower. And as you can see, price actually reaches into that. And that's how I've been using it lately, right? That's how I like using it. So as an example, I'm actually doing multiple of these because I really don't know how to explain this, what I'm being asked, because it depends a lot. And the most I use it at is when I have as an example, suppose we have liquidity, right? Price takes that liquidity, and then we have something like this. Price dropping and not dropping, just suppose that's as far as it dropped. If price starts retracing from here and I apply my Fibonacci, 50% is going to be around here. So that means that theoretically we can't really sell unless we are on equilibrium or above. That's how I like looking at it. I don't find this necessary, explained a couple of times, but thing is that for me, a fair value gap in here, as an example, could be okay, even though it is a discount. But again, ideally up here. What's the problem with Fibonacci as an example? This is, let's suppose, the 5-minute chart. If we zoom out, maybe this little bit of price action is in something like this. We had a daily move, and now we're here. This is my Fibonacci. We are definitely above premium. Above equilibrium, sorry. So we're definitely in premium prices. So that means that whatever we sell, even if it is below here, it is in this premium, but it's not on this premium, right? So it's a little bit on perspective on what we apply it to. And the way that I use it, again, most of the times is for this, or in the daily chart. When I go up to the daily chart and I understand that price has had an impulse, let's actually see if we have anything that we can use. This impulse. Let me actually check that one. The 50% is mitigated, so we could look into this one. Let's suppose we are all the way down here. What just happened? This is going back to the reversals and retracements subject. Liquidity has been taken. Can we expect a reversal to happen here? Definitely. Let's actually see if we get the reversal on the lower time frames. Just to show a little bit of an example. Look at the aggression here, how this structure is definitely broken. Important structure has been broken, so it's definitely a change in direction. Could have this been a change in direction as well? Yeah, definitely. Barely breaks the high, but definitely. So that could have been a loss. This is the problem, of course, in trying to go for reversals. But this is definitely a market shift, price risk back into fair value gaps, sweep on liquidity, aggressive with higher market shift, more fair value gaps and everything. So, but yeah, that's previous subject. So as an example, if I have this impulse, understand that the market should probably or ideally before moving lower, retrace to the 50% and then continue going lower. To understand from this point, this is a pretty simple fair value Fibonacci to use. I understand that at least to 50%, we can expect price to move higher. Not necessarily, but it could happen, right? What else do we have on the on Fibonacci on premium prices? Is fair value gap. Can price trade back into that and then continue going lower? Definitely. It's on premium prices. It's a Fibonacci. It's a fair value gap that was barely mitigated. So as you can see, it fills it and then continues with its trend. Let's see next move. Breaks the low, so we can understand that price could retrace up to the 50%. Let's see if it does. Goes a little bit lower. Let me actually see where the... Oh, okay. It moved all the way down to this. Ideally, we'd like to see price trading back into 50% before moving lower. This is the time where I most use the Fibonacci. See, now we're on 50, so we could expect price to actually go lower. Will it go lower or not? Well, it did cause a little bit of an impulse, and even here we have a tiny round liquidity, although this one is a little bit better, right? Daily fair value gap, which price just traded into. We definitely have a market shift below this low, right? And potential sells, right? Could we expect potential sells on S&P 500 next week? The analysis does make a little bit of sense. And look at this. Why did this retrace? Because it just took liquidity, needs to retrace, rebalance a little bit to then continue going lower. Maybe continue going lower. This is not a trading service, just in case. So Fibonacci is perspective-wise, right? In the 50-minute, this is our Fibonacci, but it doesn't need to be, right? Because again, on this is premium and this is discount. But if you use it like this with the big one, all of it is happening at discount, although price did trade a tiny bit above premium on here, right? So again, it's perspective-wise. When are we going to use it? To determine if a fair value gap is valid, not necessarily valid, if a fair value gap has more worth, because if it's on premium or discount, depending if we're trying to buy or sell, that's a really good area that's a good time to use the Fibonacci to just try to determine if we could have a better probability because we're a premium, we're a discount, or maybe you just want to go to a higher time frame, right? Let's suppose you want to go to the 1 hour. Let's suppose you're trying to buy from here, right? And you say, okay, so let's look what do we have in the higher time frames. Price didn't retrace back to the 50%, so we could expect price to trade a little bit lower, right? As an example, in this case, you could have missed out on a good opportunity. That's why premium and discount for me is a little bit complicated because it's not necessary in my opinion, but it does give you a nice advantage, right? If you expected sells from after this, so waiting for in here, okay? Remember we actually had a trade in here that we discussed. I think it was the, oh no, we were discussing about it just now because of the, I have no idea, but we were discussing it. Thing is that you could have expected price to trade up here and then sell, and price does trade up to 50%, right? Although with news, so that definitely would have been a miss. So Fibonacci, complicated. I use it when I already have, so step 1, step 2, this could be a Fibonacci to apply to see if a fair value gap is a good premium and discount, or again, the higher time frames that these lower time frames are trading into. That could be a good time to apply just to check out what's going on, if we're premium, if we could expect price to, if we have a better probability due to the market being on premium or discount prices, depending again if we're trying to sell or buy. It's actually some really good price action for S&P 500. Also run liquidity back here. Nice market shift and everything. That looks fine. Looks fine to continue to go lower. We'll see though. I don't trade S&P 500, but I'll definitely be monitoring it next week with that one. I think that's it. That's the questions that I had for this video, questions that I wanted to cover. Yeah, that's pretty much it. Beautiful concepts. I think I explained most of them very correctly. I really like the explanations on them. I'm proud of myself. So hope this video was of help to you. Hope I've been of help. Sorry for the lack of content, but again, mostly focused on the private community, and it is what it is. So that's it for now. Hope you enjoyed this video. Hope you took something away from it. Hope you had a nice week. Hope you have a nice week next week. And I'll be talking to you on the next one.